Hello everyone, my name's Holly Mackay, I'm Managing Director of the Platform. I'm joined today by Paul Richards, who's Head of Sales for Fidelity Funds Network. Hi Paul.
Hello.
We want to talk today just touching on the platform paper from the FCA. Now, when that was published, there was some exuberance amongst some smaller platforms who jumped up and down and perhaps a little uncharitably suggested it was the end of the bigger former supermarkets. The banning of commission was going to be problematic for you given the amount of clients you have still in bundled models. What's the Fidelity view of the world?
Well, I think to start off, I'd say that there was nothing particularly surprising for us in the platform paper itself. The ban on payments from fund partners to platforms had long been expected, as had the ban on rebates into cash accounts. So I guess that there are challenges to both the traditional fund supermarket model and to the wrap model, because I guess if you're running a wrap, your model is predicated on rebates into cash accounts, and notwithstanding this business about the £1 per fund per month de minimis, I think there are some challenges for the wraps as well. As far as the consequences of the paper are concerned for us, the biggest thing really is the move towards clean share classes. If there's no platform rebate, then we have to move into a clean share class world, and that was a move that we were already making. I think when the platform paper came out, we already had something in the region of 600 clean share classes on the platform, and this was largely in response to advisor demand.
And how's that going today, the transition?
We're up at about 1,000 as we sit here today, and you might have seen Pat Shea at our investment forum, the head of Funds Network, announcing that we'll have 95% of the assets on the platform covered by clean share classes by the end of June.
And how are you seeing the conversion amongst advisors? Has the platform paper accelerated, in your view, the transition to clean share classes?
Yeah, it certainly has, and I think we're starting to see advisors move, but they're doing it in their own time. There is a clamour, but what one must remember is this thing in the background, which is the HMRC announcement on taxation of rebates, and it's that coupled with the platform paper that's really accelerating the demand.
So a confident voice then from Fidelity. You don't see that when advisors come to review or have an annual review with a customer in a bundled situation, you don't see that that's going to be problematic for you and they may look to exit to a different platform?
No, I don't see them exiting to a different platform. I see some difficulties of communication because there's a lot of messages here for clients to take on board, and I think this is the thing that a lot of people forget. Our industry, I think, can be quite introspective and forget about the fact that there's a client at the end of every one of these investments. And as such, if you're an advisor and you sit down with a client, you might not have converted them to fees yet. So you've got a conversion to fees to deal with, you've got to move to clean share classes to deal with, and if you're in a bundled share class, you've got to explain at some point the situation with tax on rebates and why that is prompting you to make a move.
So you think there's almost enough for advisors to be talking about without then additionally saying, and I'm going to introduce another platform?
Very, very much so, yeah. And you think about the move. We're seeing, I think, some slowdown in the pace of moving from one platform to another. I think there was a lot of talk about this some months ago, and I think advisors who were wanting to move have made the move. I mean, it's a really difficult process to move, and if you look at what's going on in the re-registration arena at the moment, it's difficult. There's a lot of paper flying around the industry still, and it's causing a lot of challenges for advisors and clients and platforms and fund managers. The whole industry is in a difficult spot at the moment, and it'll work its way through it. But from an advisor's perspective, I think the last thing I'd want to be doing is moving platforms at this point, given that the platforms who have the assets are delivering an increasingly improving and broader service.
Okay, we've touched on some challenges. You're here in a way to talk about some solutions. You've launched some new multi-asset funds on the platform. What advisor need do you think that's responding to?
Well, I think our RDR has prompted a real change in advisor behaviour, and that's it's largely about the move to fees. We've done some research, and based on the cost of advisors actually providing a review to client, and I've seen various estimates. We also did some research with a chap called Clive Waller recently, and the costs of doing an annual review vary from something like £863 to £1,400, depending on who you talk to. And with that in mind, in a pure fee-based world, it becomes very, very difficult to provide a complete service from the holistic financial planning to running investment portfolios for clients who've got smaller accounts. So it's really at the smaller end of the market where we're seeing the need for a managed solution to replace what advisors were traditionally doing, which is trying to put together bespoke portfolios for clients of all sizes.
So cheap and cheerful, is that a way of describing it?
I wouldn't say, I'd say it's value for money, but it's cheerful. I think what we've launched is a comprehensive range. It's 15 funds across various strategies. And simple two questions you need to answer is what asset allocation do you want, and which type of structure do you want, from a passive range to a best of fidelity to a full open architecture range.
But here's a question, Paul, and something that bugs me. If you believe and subscribe to the view that asset allocation is the most important thing when you're looking at long-term returns, why is what you've launched, we always talk about multi-asset portfolios as being used for smaller clients, why actually, in terms of what it delivers to customers, is it any less efficient than what DFMs are offering, the guys that are typically known for being the posh client solution?
Yes, it's a good way of putting it. I think we've seen, just to be clear, I think we're trying to offer a range of solutions, and we're not saying that one solution fits all here necessarily. And as you know, we've got DFM solutions on the platform already, and we have our own model portfolio capabilities to enable advisors who want to do it themselves to manage portfolios. So we're not saying you have to do one thing or another. But to the DFM point, I think the DFM market has grown very largely, I guess, on that basis that it's more a bespoke and it's posh and it's special and the client gets a special service. And what we're saying is actually DFMs are doing that for very, very wealthy clients.
But they're also running models on platforms, which is not bespoke, is it?
Yeah, that's right. And the cost of these services is coming down also. So as I say, I'm not saying that one is right or wrong, but I think we believe that we can deliver a very, very strong investment capability with through Fidelity, and this is the combination of FundsNetwork, the platform, and Fidelity, the fund manager, coming together. So specifically, our investment solutions group, we believe, is incredibly well resourced. It manages 28 billion of multi-asset funds already. They've got 19 investment professionals. They've got about 260 years service between them. So I think we believe it's about the strength of the investment proposition. The FSA way back when talked about robust, repeatable, scalable, any number of adjectives, and I think we believe that we answer all those FSA questions really through the investment proposition that we've got.
Well, Paul Richards from Fidelity Funds Network, thanks for talking to me.
Thank you.